Millions of people lost their homes. Banks collapsed overnight, and the global economy nearly stopped. This wasn't caused by war or natural disaster. It was built step by step inside the financial system itself. In 2008, the world experienced the worst financial crisis since the Great Depression. At the center of it were banks, risky loans, and a system that rewarded short-term profit over long-term stability. This is a Fraudify investigation. This is Fraudify, where we unmask the world's biggest scams. In the early 2000s, owning a home became easier than ever. Banks offered mortgages to more people, even those with low income or poor credit. These are called subprime loans. At first, it seemed like a win for everyone. More homeowners, more profits for banks, and a booming housing market. But beneath the surface, risk was building. Many of these mortgages had low initial payments, adjustable interest rates, and little verification of income. Borrowers could afford them temporarily. But once rates increased, payments surged. Defaults began slowly. Then they accelerated. Banks didn't keep these risky loans. They packaged them into financial products called mortgage-backed securities, MBS. These bundles were sold to investors around the world. On paper, they looked safe, because risk was spread across thousands of loans. But there was a problem. If too many borrowers defaulted, the entire system would be affected. Rating agencies gave these products high ratings. Some were labeled as AAA, the safest level. Investors trusted the ratings. Pension funds, banks, institutions worldwide, they all bought it. But the ratings were based on flawed assumptions. The risk was underestimated. As the market grew, some players saw the danger. Instead of avoiding it, they found a way to profit. They used financial instruments called credit default swaps, CDS. These were essentially bets that loans would fail. Now the system had people selling risky loans, others buying them, and some betting against them. The entire structure became unstable. Housing prices stopped rising. Borrowers began defaulting in larger numbers. Mortgage-backed securities started losing value. Banks realized something critical. They didn't know how much risk they were holding. Confidence began to disappear. In 2008, the crisis reached its peak. Major financial institutions began to fail. One of the most significant moments was the collapse of Lehman Brothers. It sent shockwaves through the global economy. Markets crashed, credit froze, panic spread. The effects were immediate and severe. Millions lost their homes. Unemployment surged. Businesses closed. Governments stepped in with massive bailouts. The crisis spread beyond the United States. It became global.
And when bank shares get hammered, people's pensions get hammered, so everybody loses.
Lehman Brothers is going bankrupt after talks to pull them back from the abyss collapsed. And financial markets from Asia to Europe are doing their utmost to prevent Monday from turning from dark to black.
The 2008 crisis wasn't caused by one mistake. It was a combination of risky lending, complex financial products, weak regulation, misaligned incentives. Everyone relied on the system working. Few questioned what would happen if it didn't. The financial system didn't collapse overnight. It was built on risk, expanded through confidence, and exposed by reality. And when it finally broke, the consequences were felt across the world. This is Fraudify, where we unmask the world's biggest scams. Don't forget to like, share, and subscribe to Fraudify for more.